I don't think it's overvalued, but on the other hand, it's stunning to think that 3.5 weeks ago we were talking about 1850, 1875 level being inevitable for the S&P 500. I don't think it's overvalued simply because the good data, the important data, has been so positive. ISM data, GDP, we've added 200,000 jobs a month, 6 months in a row. All that matters, and we're just seeing a bounce back in sentiment where right now it's just the market at 2,000 seems fairly priced. And on the other hand, if you want to talk about valuations, right now the S&P 500, we're talking about $132 for 2015. That puts us 15 times earnings. I think you'd have to be the judge whether that's expensive or not. I think that's pretty fair.
What's driving? I mean, is it just a sort of accommodative stance of central bank policy mainly, a cooling in geopolitical tensions? What do you think has, driven it up this last leg?
Yeah, I think all of that, and including, like I said, the important economic data, but we've had very accommodative central bank policy. I mean, people have just come to terms that rates are going to rise sometime next year, and the timing doesn't matter that much, more about the magnitude and the destination of those rates. That's what seems to matter. Corporate valuations, I mean, good grief, 70% of S&P 500 stocks beat by an average of 4%. I mean, that's unbelievable. So that puts us, like I said, next year at 15 times earnings. There clearly are potholes with Europe and China, like maybe cooling off a little bit. But right now it seems like the U.S. is leading the charge, and the least path of resistance for us is our equity market.
And just on, I mean, what you were saying there about the timing of the first Fed rate hike, it is shifting a little, the market consensus. Just explain for us a bit more about that and your view that, yeah, it's not really the timing as such, it's going to be the magnitude that's perhaps more important.
Yeah, and obviously I need to say that timing matters if we're talking about 9 months, but I think we're talking about a period of maybe 3 months. That doesn't matter, but magnitude matters because the Fed is going to do this very gradually. What happened to our labor market? I mean, it changed in very profound ways. It's hard to understand, hard to calculate. So we're talking about maybe 25 basis point hikes as opposed to these magic hikes of a half a point or greater. And then destination, I mean, pre-crisis, we're talking rates about 4%. I think consensus now is looking more like 3.25 to 3.5 being that terminal rate. So that's making the market very, very happy indeed.
So that's for, I guess, equities. What about treasuries? I mean, are you getting a sense of, some different factors pulling at treasuries?
Yeah, that's very complicated because when you talk about U.S. fundamentals, clearly rates should be rising. I mean, we should see them rising, but we have opposing force, which would be Europe and Japan, whose rates are going down. Right now, the U.S. Treasury, the U.S. 10-year, is the cheapest 10-year out there basically in the world. So it's going to remain undervalued. I do think we're going to see rates rise. It's just not going to be in a material way, especially if we don't see some type of quantitative easing come out of Europe.
Just quickly on the currency markets as well, what are you doing right now? I mean, we've seen the strengthening in the greenback, the fallback in the euro. What are you trading right now?
Yeah, right now I have been long the U.S. dollar. One of the few things I've done right the last couple of months. It's been really painful to be short the euro. That's worked out most recently, but I'm a little concerned that that's becoming overly crowded, too much of a consensus bet. Too many people pressing on that, given the U.S. raising rates and its prerogative that we're going to see some type of QE coming out of Europe. So I'd be very nimble with that. Also, I do think the yen could pose to rally, perhaps not until the end of the year.
Larry, it's great to get your views as always. Thank you so much for joining us.
Thank you.
Larry Shover there from SFG Alternatives in Chicago.